The invisible tax. Inflation is stealing your money. You work hard, save money, and think you're making progress. But there's a silent enemy eating your wealth every day. Inflation. That paycheck you rely on, that savings account you trust, even your investments, they're all losing value faster than you realize. In this video, we reveal how the system quietly steals your money and how to fight back. Most people think that if they work hard, save money, and live responsibly, their financial future is secure. They believe that earning a paycheck, depositing it into their bank account, and watching the balance grow over time is the path to wealth. They assume that as long as they budget carefully, avoid unnecessary spending, and keep their savings intact, they are in control of their financial destiny. But the truth is far more unsettling. There is an invisible enemy silently eroding the value of their money, day by day, without them even noticing. That enemy is inflation, a quiet, relentless, and systematic force that slowly but surely steals the purchasing power of every hard-earned dollar, rupee, or euro you possess. It is not a visible thief, it does not appear in headlines, and yet its impact touches nearly every aspect of modern life. This silent erosion is what many financial experts call the invisible tax, because it functions like a levy on your earnings, your savings, and your investments, but without legislation, without public debate, and without immediate clarity. Unlike other forms of financial loss, such as a robbery or a bad investment, inflation is gradual. It is subtle. Its effects are cumulative, compounding over months and years, often unnoticed until the damage has become substantial. Every paycheck you receive, every note in your wallet, every figure in your bank statement is affected. And over time, this diminishes your ability to afford the very things you worked so hard to achieve. To understand the invisible tax, we first need to grasp the fundamental mechanics of inflation. Inflation is essentially the rise in the prices of goods and services over time. When prices increase, the same amount of money buys less than it did before. If last year a loaf of bread cost $1 and this year it costs $1.10, the real value of the money you saved last year has already decreased. That 10-cent increase may seem insignificant at first glance, almost negligible. But when you apply this percentage increase to every purchase you make over months and years, the impact becomes enormous. Groceries, fuel, rent, utilities, clothing, entertainment, education, medical costs, all of these essential and non-essential items gradually demand more of your money. A lifestyle that once felt manageable begins to feel constrained. The same paycheck that covered your living expenses comfortably last year now feels stretched. Subtle, almost imperceptible, yet real, inflation creates a sense of financial pressure without altering your income. This is why it is called invisible. It rarely appears as a single catastrophic event, but its cumulative effects can quietly destroy long-term financial security. While the average person struggles to notice the impact in daily life, the financial system is acutely aware of it. Central banks, governments, and financial institutions actively manage inflation, sometimes subtly, sometimes overtly, because it serves their economic objectives. Moderate inflation is often portrayed as healthy for an economy. It encourages spending, motivates investment, and prevents the stagnation that occurs when money holds value indefinitely. However, while inflation may theoretically benefit the macroeconomy, it disproportionately impacts those without significant assets or investments that grow with or faster than inflation. Middle-class families, recent graduates, small business owners, and everyday wage earners experience the brunt of this invisible tax, often without realizing it. While stockholders, property owners, and the wealthy benefit from asset appreciation that outpaces inflation, those relying primarily on cash savings or fixed incomes experience a decline in real wealth. They are the silent victims of a system that has normalized this gradual erosion of purchasing power. The most insidious part of inflation is that it masquerades as normalcy. Prices rise incrementally, often just a few percentage points each year. At first, it is easy to dismiss these increases as minor fluctuations, seasonal adjustments, or unavoidable changes in supply and demand. People adapt, adjust, and continue their routines, unaware that over time, these small changes add up into a significant loss of purchasing power. A salary that feels adequate today may fail to cover the same standard of living a few years later. A savings account that promised security begins to fall behind, unable to keep pace with rising costs. And yet, most people continue to operate under the assumption that their money holds the same value it did when they first earned it, failing to account for the gradual reduction caused by inflation. This cognitive dissonance creates a dangerous illusion, the belief that financial stability is within reach, when in reality it is slowly slipping away. One of the most striking examples of the invisible tax is in the realm of long-term savings. Consider someone who deposits money into a traditional savings account, believing it will grow over time. Banks often offer interest rates that appear attractive on paper, but in many countries, these rates lag behind the pace of inflation. The nominal balance may increase, but the real value of the money, the actual purchasing power, declines. 1,000 units of currency saved today may be technically more than 1,000 units a few years from now, but in terms of what those units can actually buy, the saver is worse off. Without awareness and strategic action, saving money in low-interest accounts can paradoxically lead to a gradual decrease in wealth. This is why the invisible tax is so dangerous. It targets behaviors people traditionally associate with prudence, such as saving and financial caution, and turns them into potential liabilities. Inflation also undermines the perception of financial progress. When people receive raises, bonuses, or promotions, they often feel that they are moving forward. They may increase spending, upgrade lifestyles, or make larger purchases. Yet if their wage growth does not outpace inflation, their real income, the amount they can actually buy, has not improved. In essence, they are running in place financially, working harder while their purchasing power erodes. This creates a subtle but pervasive cycle. Individuals believe they are advancing, yet their ability to achieve long-term financial goals, such as buying a home, saving for education, or investing for retirement, remains constrained. The invisible tax operates silently, steadily, and often invisibly, undermining life plans without drawing immediate attention. Beyond personal finance, inflation has broader societal consequences that shape daily life. Housing markets rise, rents increase, tuition fees climb, and essential goods cost more with each passing year. Families who once could afford modest comforts now find themselves adjusting their lifestyle incrementally to meet the new price reality. Children's education, healthcare, and even leisure activities require more money than anticipated. The invisible tax becomes an ever-present background pressure, forcing trade-offs that were unnecessary in the past. Families that diligently save and plan can still feel financial strain because the value of their efforts diminishes over time. What is remarkable about this phenomenon is its universality. Inflation affects everyone, regardless of geographic location or occupation, but its effects are most pronounced on those who depend primarily on earned income rather than appreciating assets. The psychological impact of inflation should not be underestimated. Even though individuals may not consciously recognize the slow erosion of wealth, its consequences manifest in stress, anxiety, and frustration. People often blame themselves for not managing money properly, not realizing that a structural force is quietly at work. This misplaced attribution can lead to overworking, overspending in attempts to compensate, or pursuing quick-fix financial solutions that exacerbate the problem. The invisible tax becomes not just a monetary issue, but a psychological burden, shaping behaviors in ways that may further compromise long-term financial stability. Some experts describe inflation as a silent predator because it capitalizes on human tendencies toward short-term focus and delayed perception. Its effects are rarely immediate, yet they accumulate relentlessly. The very strategies that people employ to maintain financial security, saving in cash, relying on fixed salaries, cautious budgeting, can become vulnerable if inflation is not accounted for. Meanwhile, individuals with assets that appreciate with inflation, such as real estate, stocks, or commodities, experience wealth growth passively. This divergence creates a widening gap between those who understand and strategize around inflation and those who are caught unprepared, reinforcing cycles of inequality. Despite its invisible nature, the power of inflation is quantifiable. Even moderate annual inflation rates of 2 to 3% can reduce the real value of money significantly over a decade. For example, an amount that buys a certain basket of goods today could require 20 to 30% more money in 10 years to purchase the same items. Over multiple decades, the erosion becomes dramatic. This cumulative effect is why financial planners emphasize the importance of investing in assets that outpace inflation, leveraging the compounding effect to preserve and grow real wealth over time. Understanding the invisible tax is the first step in regaining control over financial life. Awareness shifts perception. When people recognize that their money is losing value silently, they can begin to make proactive choices. Adjusting saving strategies, investing in inflation-resistant assets, diversifying income streams, and monitoring purchasing power become essential. The invisible tax is not something that can be eliminated entirely, but it can be managed strategically. Knowledge of its mechanics transforms anxiety into action, allowing individuals to navigate economic realities more effectively and regain a sense of control over their financial future. The invisible tax also exposes the limitations of conventional financial advice that emphasizes saving cash alone as a path to security. While budgeting and frugality are important, they are insufficient in a system where money loses value annually. True financial resilience requires an understanding of the broader economic system, proactive asset management, and deliberate decisions that account for inflation's impact. This may include investing in equities, real estate, commodities, or other financial instruments that historically outpace the rate of inflation, providing both growth and protection. By the end of this exploration, one principle becomes clear. Money that sits idle loses value, and time is the enemy of static wealth. Hard work, disciplined saving, and careful budgeting remain essential, but they must be paired with awareness of inflation's hidden toll. Only through deliberate strategy, continuous learning, and conscious financial decisions can individuals begin to reclaim the value that is silently being eroded by the invisible tax. What many people consider financial security may, in reality, be a temporary illusion, vulnerable to the slow but persistent forces of rising prices. Understanding the invisible tax changes everything. It forces a reconsideration of long-held assumptions about money, saving, and financial progress. It reveals the hidden cost of inaction and challenges the belief that careful budgeting alone is sufficient. Those who recognize this system early gain a critical advantage, the ability to act proactively, to make decisions that preserve and grow wealth, and to navigate the complexities of modern finance with foresight and clarity. And at this point, most people are left with a choice. Continue unknowingly surrendering purchasing power to the invisible tax, or confront it strategically, adjust their approach, and take the first step toward reclaiming control over their financial future. Once you fully grasp how inflation quietly erodes your wealth, the question becomes unavoidable. What can you do about it? Ignoring it is no longer an option because time works against you. The longer your money sits idle in low-interest savings accounts, the more purchasing power it loses. Every day that passes without action, the invisible tax continues its silent theft. The first step is awareness, truly acknowledging that traditional saving, while comforting, is insufficient to maintain financial security in an inflationary world. This realization is both liberating and daunting, because it means the responsibility for preserving wealth rests squarely on your own shoulders. There are no shortcuts or guarantees, only strategies informed by knowledge, discipline, and foresight. The second step is to make your money work for you rather than simply storing it. One of the most effective ways to combat inflation is by investing in assets that historically appreciate faster than the rate at which prices rise. Stocks, for instance, represent ownership in businesses that grow over time. Their value increases as companies generate profits, expand operations, and adapt to market demand. Over the long term, equities tend to outpace inflation, providing both growth and a hedge against the invisible tax. Similarly, real estate offers the potential for appreciation and passive income through rent. Property values and rental income generally rise with inflation, allowing investors to maintain purchasing power while others see their savings eroded. Even commodities such as gold, silver, and energy resources can serve as protection because they often retain intrinsic value when fiat currencies lose strength. Diversification is critical. Relying on a single asset class is risky because all investments carry inherent uncertainties. Inflation can behave differently depending on the economic context, interest rates, government policy, and geopolitical events. By spreading capital across multiple assets, you mitigate the risk of any single investment being insufficient to preserve wealth. Moreover, strategic asset allocation is not about following trends blindly. It is about aligning your investments with both your goals and the long-term objective of outpacing inflation. Those who understand this principle gain a psychological advantage. Money is no longer merely stored for future use. It actively grows and protects itself, compounding over time. Another essential strategy is understanding the difference between nominal and real returns. A nominal return is the raw percentage increase in the value of an asset, while a real return adjusts for inflation. For example, if your investment grows by 5% in a year, but inflation was 4%, your real growth is only 1%. Many individuals mistakenly celebrate nominal returns without accounting for the invisible tax, believing they are achieving progress when, in reality, they are barely preserving purchasing power. Recognizing this distinction is crucial because it shifts the focus from superficial gains to true wealth growth, measured in terms of what your money can actually buy. Budgeting and spending habits also play a pivotal role. While investments protect against inflation, controlling expenses ensures that wealth is not continually lost to unnecessary outflows. It requires a disciplined approach to differentiate between needs and wants, distinguishing between purchases that genuinely enhance quality of life and those that simply inflate lifestyle temporarily. Each dollar spent on unnecessary consumption is a dollar vulnerable to the invisible tax because the value lost cannot be recovered or redirected into growth-oriented assets. Thoughtful consumption, combined with strategic investment, creates a synergistic effect, preserving both immediate purchasing power and long-term wealth. Timing, while often misunderstood, is also important. Inflation is not static. It fluctuates depending on economic cycles, government policy, and global conditions. Awareness of macroeconomic trends can provide guidance in adjusting investment strategy, whether that means increasing exposure to inflation-resistant assets, reducing reliance on fixed income instruments that lag behind inflation, or reallocating resources to sectors likely to benefit from price increases. This does not mean attempting to predict markets with precision. Such attempts are usually futile, but rather maintaining a flexible, informed approach that acknowledges economic realities. In doing so, individuals position themselves to minimize losses, and maximize the protective effect of their financial decisions. Psychological resilience is equally critical. Inflation often creates stress, uncertainty, and a sense of urgency, particularly for those who have relied on traditional saving methods for decades. The realization that money is losing value can provoke fear or even paralysis, leading to reactive decisions that may worsen outcomes. Successful navigation of the invisible tax requires patience, long-term vision, and the ability to act rationally in the face of gradual financial erosion. This mindset shift transforms fear into proactive strategy, enabling individuals to implement plans that counteract inflation rather than merely endure it. Education and continuous learning are fundamental tools. Understanding the mechanics of money, finance, and the broader economy allows individuals to make informed choices. Awareness of historical inflation trends, the performance of different asset classes, and the impact of government monetary policy equips people with the knowledge necessary to protect wealth effectively. It is no longer sufficient to rely on traditional advice, such as saving in a bank account or holding cash reserves. A sophisticated understanding of money dynamics is essential to navigate the complex landscape of modern finance, where inflation quietly undermines those who remain uninformed. Strategic borrowing can also play a role, paradoxically, in combating the invisible tax. While debt is often vilified, not all borrowing is detrimental if managed wisely. Low-interest loans, mortgages, or lines of credit can be leveraged to acquire assets that appreciate faster than the cost of borrowing. This is the principle employed by financially literate individuals and institutions. Money is not merely spent, it is strategically deployed to generate growth, income, or value that exceeds the cost imposed by inflation and interest. In this sense, debt, when controlled and intentional, becomes a tool to counteract the invisible tax, rather than a liability that compounds it. Automation and planning can further enhance financial resilience. Automating investments, regularly reviewing portfolio allocations, and scheduling periodic reassessment ensures that strategies remain aligned with changing economic conditions. This approach prevents complacency, reduces the likelihood of reactive or impulsive decisions, and ensures that financial plans continue to outperform inflation. It also instills discipline, allowing individuals to maintain consistency, even in periods of uncertainty or distraction. Over time, this discipline compounds into tangible results, preserving and enhancing the real value of money. Lifestyle alignment is the final, but no less important, component of combating the invisible tax. Long-term wealth preservation requires coherence between financial goals and everyday choices. Living below one's means, prioritizing investments over consumption, and maintaining financial flexibility are behaviors that reinforce resistance to the erosive effects of inflation. Conversely, unchecked lifestyle inflation, the tendency to increase spending as income rises, magnifies vulnerability to the invisible tax. By consciously aligning lifestyle decisions with wealth preservation strategies, individuals ensure that incremental gains are not lost to rising prices and unnecessary expenditures. Ultimately, understanding the invisible tax reframes the way people perceive money. It exposes the quiet erosion of value that occurs even as individuals work hard, earn more, and save diligently. It challenges assumptions about security and highlights the necessity of proactive, informed decision-making. Those who recognize this system gain an advantage. They can make strategic choices that protect, preserve, and grow real wealth over time, while those who ignore it continue to see their purchasing power decline. The invisible tax is relentless, but awareness, education, strategy, and discipline transform it from an unstoppable force into a manageable challenge. When individuals adopt these principles, they shift from passive participants in the economic system to informed architects of their own financial destiny. Money ceases to be merely a static tool. It becomes an active instrument for growth, protection, and freedom. Investments, asset allocation, disciplined spending, and strategic planning collectively act as armor against the erosion caused by inflation. The invisible tax, once a silent predator, is mitigated, and financial independence becomes not just a theoretical concept, but a practical, attainable reality. The journey is not easy, nor is it instantaneous. Fighting the invisible tax requires long-term commitment, continuous learning, and the willingness to confront uncomfortable truths about how money behaves. Yet the payoff is profound. Preserved purchasing power, growing wealth, and a future in which financial decisions are guided by strategy rather than reaction. This is the essence of financial empowerment in an inflationary world, the principle that separates those who thrive from those who merely endure. And as awareness spreads, the invisible tax begins to lose its power. The knowledge that money is not static, that value erodes quietly over time, and that deliberate actions can counteract this effect becomes the cornerstone of financial resilience. With each informed decision, each strategic investment, and each conscious choice to prioritize long-term stability over short-term gratification, the invisible tax is no longer a hidden enemy. It is a challenge that can be anticipated, mitigated, and ultimately overcome. Those who embrace this perspective discover a powerful truth. Wealth is not solely a function of income, savings, or effort. It is a function of understanding, strategy, and proactive management. In an economic system where inflation is an ever-present force, only those who adapt, learn, and act decisively can maintain and grow their real wealth. The invisible tax, once a silent thief, becomes a navigable factor in a broader financial strategy, one that allows individuals not just to survive, but to thrive in a world where prices rise, value shifts, and opportunity favors the informed. The invisible tax is real, it is pervasive, and it is relentless, but it is not insurmountable. Awareness transforms risk into opportunity, strategy transforms loss into growth, discipline transforms vulnerability into empowerment. The challenge of inflation becomes a test of financial literacy, resilience, and foresight. Those who rise to that challenge reclaim their money, their power, and their freedom, proving that even the quietest of adversaries can be confronted and ultimately conquered through knowledge, action, and perseverance.